Hello and thanks for tuning in. This is Kevin Walton with C2 Reverse. Today I'm going to show you a new reverse mortgage loan product for people over the age of 55. But first, here's my contact information here. And if you would please, when you're watching this video, the bottom right there's a red button that says subscribe. Click on that. Then you get notified of any new reverse mortgage video for any new product that's coming out, or how to use a reverse mortgage in certain situations. You'll get notified. I would appreciate it. So let's go ahead and dive in here. In this video, I will show you the actual numbers for a loan scenario, snapshots of the reverse mortgage loan balance after 3, 5, and 10 years, and also the difference between this loan and an FHA HECM reverse mortgage loan. So what can you do with this loan? You can use a loan to buy a home, refinance the existing home loan, take out a reverse mortgage line of credit, or draw a lump sum. Now this loan is not a HECM reverse mortgage loan. That's the loan you hear mostly about on TV. It is not in the family of FHA federally insured loans. So this loan has its own set of guidelines different from the HECM reverse mortgage. Now HECM stands for Home Equity Conversion Mortgage, if you didn't already know that. It is in the family of FHA loans, the HECM is. This loan, the 55 and over reverse mortgage loan, does not come with the federal insurance that the HECM comes with. So inherently, this new loan has much lower closing costs than the HECM reverse mortgage. In exchange for not having that insurance on that loan, the interest rates are higher on this loan, and there's lower loan amounts as well. I'll show you a slide on this in a few minutes. But there are some similarities to the HECM. For one, no mortgage payments are required on this loan, although you can make payments if you like, for as much and often as you like. As with the reverse mortgage, if you choose to not make a monthly mortgage payment, the unpaid interest calculated for the month gets tacked onto the balance of the loan. So the loan balance will rise over time. I'll show you a slide in a few minutes that demonstrates this as well. Income qualifying for the loan is much easier than a forward mortgage loan. Now when I say forward mortgage loan, I mean a loan where you show income documentation and you make the same payment for 30 years every month, and you see your balance go down. That's a forward mortgage. In exchange for not being a minimum of 62 years of age, like you have to be on the HECM reverse mortgage, again the interest rate is higher and you get less money, but that's a trade-off with the 55 and over reverse mortgage. On this non-HECM loan, if you ever owe more on the balance of the loan than the home is worth, and it comes time to pay off the loan, the lender absorbs the difference. That's what you call a non-recourse loan. You are not responsible for that difference or your heirs. So like other reverse mortgage loans, the 55 and over reverse mortgage loan, again, is non-recourse. So who can this loan help? For one, COVID-19 has thrown a large portion of people over the age of 55 into a situation where their income was cut in half, or their business or job dissolved altogether. Some people were forced into retirement and had to or are currently living on savings and may possibly outlive their money or have to sell their home. Many Americans took advantage of the federal mortgage forbearance program, where they didn't have to make a mortgage payment for a year to 18 months. But now, that forbearance has expired, and many still can't afford to make that monthly mortgage payment, So now what? This loan can help those people. Many of these people in this situation have a chunk of equity in their home, and if it is enough, and if they are over the age of 55, this loan could possibly keep them in their home, create cash flow to allow them to live more comfortably by not having a mortgage payment. They may not have to prematurely draw as much money out of their savings and retirement as well, so their nest egg will last longer due to the availability of this loan. So to determine a reverse mortgage loan amount, the three factors needed are the age of the youngest borrower, the home value, and prevailing interest rates. Each reverse mortgage loan amount for each borrower can be uniquely different since these three factors will vary. So here's a scenario for a 55 years of age and over reverse mortgage applicant. Bob is a 56-year-old who owned a once bustling neighborhood cafe. And after struggling through COVID and the lockdown, he ended up having to unfortunately close his business. And now he's working 2 part-time jobs and is struggling to make ends meet. He makes $2,800 per month in income. Bob has a home he's lived in for 25 years, and the approximate home value is $650,000. He has an existing mortgage balance of $250,000 with a monthly payment of $1,700. We're going to assume Bob has had this real estate loan for the last 10 years or so, because being self-employed, he hasn't been able to qualify for a refinance due to a lack of documentable income on his tax returns. He also has an auto loan of $450 and credit card payments of $500 per month. So finances are extremely tight, and he really doesn't have enough left over to pay for food and utilities. He uses his credit cards to pay for those. And Bob's living circumstances are not unique. There are quite a few people out there in this situation in 2021. Many are struggling. Using Bob's age, lendable equity, and prevailing interest rate, Bob can obtain a 55 and over reverse mortgage loan for $260,500. This pays off the existing mortgage and gives him $5,000 as well, cash in hand, or cash out, which could help with paying down debt. In this scenario, the only loan available for Bob is the fixed rate lump sum loan option. The line of credit option is not available, but with additional home equity and possibly Bob being a little older, the line of credit option may be an option, but as with this loan scenario, it is not. So let's take a look at some numbers here. Here's the loan that Bob was able to qualify for. We'll start right up here in the upper left-hand corner. Principal limit in reverse mortgage Tech Talk is loan amount. So this was his loan amount. The balance was $250. Closing costs roughly $5,000. Probably much lower than that, but I'm just being a little bit on the high side to make sure we're not short. Then that leaves $5,650 as cash out for Bob on top of that. Now we're looking at a rate here. It's not a very low rate, right? It's 6.99, but keep in mind this is a very risky loan. And it is stretched to the maximum. If we go down here, there's several rates that are available, all the way down to 4.9%. Now these rates would be available if there was additional equity in the property or if Bob was older or a combination of the two. 6.99 is the top end rate because we're giving the maximum loan amount possible at this age. I wanted to highlight this higher rate to let you know what it looks like. We're not hiding anything here. But again, this can solve a lot of Bob's issues. Now, what does this loan look like in, let's say, 5 years from now? This is an amortization schedule based on Bob not making any monthly payments on this loan. We're going to just say the home appreciates for 4% per year. So by the end of the first year, Bob's home is now worth $676,000 instead of $650,000. The loan balance has gone from $265,000 to $273,405. That's the accumulated interest that Bob has not paid on the loan for the first year. Let's go down the third year here, $314,000. Go down the fifth year, $361,000. 10th year, $511,959. So by that 10th year, this loan starts to really add up. This is only if Bob has not made any monthly payments. Let's say Bob is able to make a $500 payment a month. Look where the balance goes now. Down to $325,000. That's quite a bit. Even by making a $500 payment. It's not the $1,700 payment Bob had to make before on his forward mortgage. But just this little payment can knock that down. And instead of $511,000 owed after 10 years, it's $425,000. Now this home by year-end value in 10 years, that may not be realistic. It's 4% per year. But let's just say if the home doesn't appraise for any more than $676,000 for 10 years. Worst case scenario. He still owes $425,000. There's still a gap in there where if Bob had to sell the home, he can and still walk away with a little bit of money. Wanted to highlight this because people think, well, over time, they're going to be owing much, much more than the value of the home. And that very well could be. But if Bob wants to possibly pay this loan off, once he gets gainfully employed again, he can. And if not, he can keep the loan and make regular payments on it as he sees fit. And then if life happens, whether there's a health issue or another job loss, he has this loan to lean back on. If Bob made payments of $1,700, just for example, if he was able to get his income back in place, then the loan balance gets paid down just like any other loan. It doesn't go up because you are making the full interest payment required and then some principal as well. I do these scenarios for people all the time. I keep in contact with all my clients over the years. And over the next year, I'll say, how's it looking? You going to make any monthly payments? If they need to know what their monthly balance is going to, or yearly balance is going to be, I can give it to them using this program. Financial planners as well. I give this to them as well when they're going over their financial plan annually. So, the scenario after Bob gets this loan, he doesn't have to make a mortgage payment if he doesn't want to, or he can make a partial payment of any amount as often as he likes. He doesn't have to sell his home or even possibly lose it to foreclosure to the bank. He has improved quality of life and flexibility. And once again, if he's fully employed, he can pay off the loan and obtain a forward mortgage. This gives Bob a lot of breathing room. And quality of life and peace of mind, you can't put a dollar amount on that. So even if the balance does rise over time, it could be better than the alternative of Bob having to move, relocate, rent, and everything that comes with that. So this loan may not make sense for some people depending on their situation and their family dynamic, but it does create another option instead of selling the home or again possibly losing the home altogether to foreclosure. So you always want to ask the question with these loans, what's the difference between this loan and a HECM reverse mortgage? There are different guidelines that come with this loan, and you need to know those. And I go over those with all my clients. So thanks for watching, and make sure and subscribe to my YouTube channel. There are always new unique reverse mortgage programs that are coming out, and I'll make videos on each of them to let you and others know how they work. So again, thank you. Have a great rest of your day. And again, this is Kevin Walton with C2 Reverse. And if you need to know any kind of specifics or run a scenario by me, you can email me. My email is there on the screen at kwaltonucf, like Uncle Charlie Frank, kwaltonucf at earthlink.net, or just give me a call, 805-276-1942. I'm in Ventura County, California, but I lend all over California. And I'd be glad to run some numbers for you, go over the guidelines for each of these loans and how they work, and see if this is a good fit for you. Thanks again. Bye.